Hello, welcome to the Capital Employed podcast. For this episode, we had the pleasure of being joined by John Kingham. He is the founder of the UK Dividend Stocks Newsletter and author of The Defensive Value Investor that was published by Hariman House in 2016. In this episode, John discusses his journey as a private investor, why he likes dividend stocks, his investing checklist, and 2 companies in his portfolio he's bullish on for the long term. This is a great episode and I think you'll really enjoy it. Before we begin, every so often we'll be doing write-ups about stocks from around the world that have piqued our interest. These will be mostly companies on the smaller end of the market cap scale that go under the radar of most financial media. So if that sounds like your cup of tea, visit capitalemployed.substack.com and add your email to the list. That's capitalemployed.substack.com. Okay, let's dive into this week's episode. Please enjoy my conversation with John. Hi John, thanks for coming on to the podcast. Can you provide a brief introduction of yourself and how you got involved with investing?
So my name's John Kingham and I write a blog and a newsletter at a website called UKDividendStocks.com. I started investing in the mid-1990s. I started to earn more money and I began to think about my retirement. So I started to save up and I started to put the money into just a FTSE all-share tracker. So that was all I wasn't interested in investing at all. All I wanted to do was just save up for my retirement. So that was from the mid-90s. And then obviously there was the dot-com bubble and then there was the dot-com bust. And I ended up I'd sold everything in around 2003, pretty much the bottom of the bear market, because my investments had gone down by 50%. I didn't know what was going on. So I kind of panicked and sold everything. And that could have been the end of my investing journey back then. But what we did is in 2004, we ended up selling a house and we didn't buy another one. We wanted to go and rent for a while and live out in the country and so on. So I had this big chunk of equity that we had from this house. So then I wanted to invest that. So because I now had much more money to invest, I wanted to take it more seriously. So I started reading about investing and that led me on to Ben Graham's book, The Intelligent Investor. So I kind of I got back into the market as a passive investor again, but then I gradually shifted towards value investing, and initially was deep value investing. So investing in fairly rubbish companies that are trading at extremely low valuations. And that kind of worked out okay for a while, but that was about 2007 I started doing that, which was around the time I initially started a website just to blog about my experiences. And so I was a deep value investor from about 2007 to about 2010. And then I found that didn't really fit with my personality. I didn't really like investing in fundamentally rubbish companies. So I kind of shifted to a more quality, defensive kind of value investing. And I've been doing more or less the same thing ever since.
Why focus exclusively on dividend stocks? What makes dividend paying stocks so attractive for you?
I think it is just a personal thing, really. I don't think dividend investing is intrinsically better than any other approach. It fits my personality. I just like to be invested in larger, more well-known, more successful, more defensive, reliable kind of companies. I guess ultimately at some point, if I decide to retire, then my plan would be to retire and live off just the natural dividends that the portfolio pays out. So from that point of view, it's practical. But it's just that these kind of relatively defensive dividend stocks, it just fits my personality.
Can you talk us through your investment checklist? What type of businesses or characteristics are you looking for?
Yeah, so I've got a checklist that I've gradually kind of incrementally built up and improved over the last 10 or 12 or whatever years. And so fundamentally, I'm looking I want the portfolio to produce a progressive, a kind of a high and rising dividend. I think that's the best description of it. So a progressive dividend with a good yield. So I'm looking mostly for companies that fit that kind of description. So there are three main traits that I look for. First is quality, then defensiveness, and an attractive valuation. So quality is basically, I'm looking for companies that can outcompete their peers consistently over time. Because if the company's going to grow, it needs to be able to stand its ground and even take ground and market share from other companies. So, you're looking for things like, you look at history. Has the company got a track record of being able to take market share or move into adjacent markets and just grow over time? And you're looking for things like, does it have an above average return on capital, which is often probably the strongest indicator of a company that is unusually competitive or has got durable competitive advantages. And so that's another key thing that I look for. I try to look for companies that have got some kind of advantage that is going to help them compete and win against their peers over time. And that can be lots of different things. Like, it could just be scale, it could be their brand or network effects or switching costs. There are lots of different things. So that's quality. It's basically a company that can outcompete its peers over time. And then defensiveness is basically how robust is the company. So an obvious question is whether the core market is defensive. So if it's a mining company, then yes, its production might be relatively stable, but commodity prices shoot up and down so much that the outputs of the company, the profits and dividends, are unlikely to be stable. So that's not really what I would be looking for. So so you've got this question of whether the core market is defensive. You need the core market to be growing, because if the core market is in decline, like tobacco stocks, one of the problems with tobacco stocks, even though I own one, is that the core market is shrinking. So it's hard to call a company defensive if the core market is shrinking, because it's not going to be able to defend against inflation over time if the company ends up shrinking. And then there's lots of other things. So one of the things, or the areas of things that I look at, is whether the company internally is defensive or robust or not fragile. So there are lots of things that can make a company fragile, even if it operates in a defensive industry. It could be reliant on a small number of suppliers or a small number of customers, or it could have a specific product that it's built around, which at some point might become obsolete and need to be replaced, and then you don't know if the replacement product is going to be as good. And an obvious thing that can make companies fragile is debt. So if a company's got tons of debt, doesn't matter if it's a tobacco stock, if it's got enormous mountains of debt, then that's still obviously an issue and undermines the robustness of the company. So that's defensiveness. And then the last thing is valuation. And my approach to valuation is it follows on from the idea that theoretically the value of a company is the present value of its future cash returns to shareholders. So when I'm valuing a company, I build a discounted dividend model of its future dividends. So you basically model out what's a reasonable and conservative estimate of its future dividends. And then you discount those back to today to come up with an estimate of fair value. And then you can easily just compare the current price to your estimate of fair value. You can see if there's a margin of safety there. And if the margin of safety is big enough, then it's an attractive valuation. So that's the kind of the fundamental, the three building blocks is quality, defensiveness, and then valuation.
Is there like a minimum dividend yield that you wouldn't go under?
Yeah, at the portfolio level, I'm aiming for 5% at the portfolio level. But in terms of individual companies, I don't have a lower limit. Having said that, if there were two companies that were broadly similar in terms of quality, defensiveness, and valuation, then yes, I would probably favour the one that had the higher yield.
And what would cause you to sell? Would it simply just be a cut in the dividend yield?
No, I wouldn't sell just because there's a dividend cut, because what I'm trying to do is focus on the long term. So I'm looking in terms of quality. I'm looking at what are the factors within the company that give it a long term competitive advantage, and the valuation. Again, I'm basing the valuation on what's a reasonable estimate of dividends over the next 10 years and more. So a dividend cut in a single year isn't necessarily a reason to sell. It depends if it reflects a fundamental, decrease in the quality of the business, or a change to the long-term expected dividends. Then yes, it might be a reason to sell. But if a company like AG Bar, which I used to own, the maker of Iron Brew, they suspended their dividend during the pandemic, but that didn't reflect any significant impairment to the underlying business. It was just a short-term decision made by management to protect the business in a situation where they didn't know how bad, the pandemic and lockdowns were going to be. So it was just cautious to suspend the dividend for a year. And once things panned out a bit and they could see that it wasn't the end of the world, then they reinstated the dividend. So that single dividend cut didn't fundamentally impair the fair value of the business.
And how many stocks do you normally hold in your portfolio?
I used to aim for 30, but over time, my analysis has got more detailed. And so I find it difficult to run a portfolio of 30 companies. So I've started to concentrate down. I've brought my portfolio down to about 25 now. I'm kind of aiming for around 20. And the other benefit of concentrating more on fewer holdings is that you can put more money into your best ideas. So if you own 1,000 stocks, then there's not 1,000 amazingly valued stocks in the entire world. So you have to rank them from 1 to 20. I think from 1 to however many you've got. And Buffett said something along the lines of, why would you want to put more money into your 25th idea when you could put more money into your best idea?
So if we can jump into your portfolio, can you talk about 2 stocks that you feel have great long-term potential? And what was your thesis for investing?
Yeah, so the first company is Legal & General, which most people would have heard of. It's a large pensions, life insurance, investment management business. So the way that I think about Legal & General is its core business is providing a full range of services across the full life cycle of institutional defined benefit pension schemes. So if you think of a DB's pension scheme, the first thing you set up a new pension scheme, the first thing you need, everybody starts paying into their pension. So you need investment management expertise. That money needs to be invested to produce a return. And so obviously Legal & General is the UK's largest investment manager. I think they might be Europe's largest, but they're certainly one of the world's largest investment managers with over £1 trillion of assets under management. Legal & General can cover that. And then as the pension scheme matures and they start to think more about paying money back out to pensioners as people within the scheme retire, then the scheme can look to do things like liability-driven investing, which is where you're thinking about the cash flows coming out and you'll need to meet them, because obviously with a DB scheme, you have contractually obligated liabilities. You have to pay the pensioners some certain percentage of their final salary or whatever. And so there's various tools around that. There's like lots of different insurance elements, like you can insure the cash flows against inflation or currency risk or interest rate risk. And you can use insurance against the pensioners living longer than the scheme expected them to live. So obviously the longer the pensioners live, the more cash you have to pay out. So that's a risk which you can insure against. So Legal & General can, do all of those various types of insurance. As schemes mature, they might want to offload chunks of their of the people within the scheme, the pensioners, and just buy like a bulk annuity to pay for those pensions. So kind of completely remove the risk from the company, the sponsor, the company whose DB scheme it is, and you just kind of offload a whole chunk of the people to Legal and General by buying a bulk annuity. So what that does is when Legal and General, they get paid for this, to do this bulk annuity, they'll get paid however millions of or billions of pounds. Once you've bought an annuity, that capital then sits with the insurer. So in Legal and General's case, they have this capital, and they know they're going to have this capital. They've never got to give it back. They have to pay the income stream, but they haven't got to give the capital back. So they've got this capital for decades. So what they can then do with it is they can use that to fund the creation of real alternative assets, which is things like student accommodation, retirement villages, or science parks or media parks. They can invest in these real assets that then produce a higher and more reliable income than you could get from public market assets. And you can then use those cash flows, to pay out the funds to the pensioners. And then at the kind of the last phase is where a company might decide to completely get rid of its DB scheme and hand the whole thing over to an insurer like Legal and General, just to get it off its balance sheet and just completely eliminate all pension-related risk. And Legal and General can do that as well. So as far as I know, Legal and General is the only company in the world, or at least it was the last time I looked, that can do this whole kind of remit of different services for DB pension schemes. There are other companies that are trying to acquire businesses to bolt together the same set of services, but Legal and General has already been doing this for years, so it's certainly got a head start. So that's the basic business model. And in terms of quality, defensiveness, and valuation, I don't want to go on forever, but the quality, it's whether it can outcompete its peers. It's already been around for 200 years. It's a UK market leader. It's got a good track record of mid-single-digit growth, consistent growth. It's got a return on capital employed in double digits. It's got scale. It's got a fantastic reputation. It's just got a lot of the traits of a quality company that I'm looking for. And then in terms of defensiveness, fundamentally the pension business is very defensive, because people are paying into their pensions all the time, and once they've got the assets, they just get the investment management fees, which just come in consistently. It's just a very steady, long-term business. There are risks. One of the main risks is to do with the balance sheet, where as a pension business, you've got the liabilities on the one hand, and you've got all of the assets that you're gathering from people on the asset side. And so there's a risk. There's a kind of inherent leverage in insurance companies, and so there is a risk that a significant market decline can weaken the company's balance sheet, which is what happened in the GFC, in the global financial crisis. They had to cut the dividend for a couple of years to strengthen the balance sheet. But as far as I can tell, looking at the regulatory capital cover, the amount of capital, the kind of buffer that they have to have within the business, that's almost double the regulatory minimum. So from that point of view, it looks like they've got a strong balance sheet. So in my opinion, I think it's a defensive business. And finally, on the valuation, the company's got a track record of mid-single digit growth. Management expect the dividend to continue growing at about 5%. My discounted dividend model has the dividend growing at about 4%, so slightly more cautious than management's expectations. But the dividend yield at the minute is about 8%, just shy of 8%. So you've got an 8% yield from a company that has a mid-single digit growth rate that is, in my opinion, it's reasonable to assume that can carry on for the foreseeable future. So my estimate of fair value is about £6, and the company's share price, when I last looked, was about £2.50. So there's an enormous gap between my estimate of fair value and the company's share price. So either I'm completely wrong or the share price is extremely cheap. I think is extremely cheap. So that's why Legal in General is one of my largest positions.
First glance, it does look very cheap.
It does. I think with the yield at 8%, we're into the zone where people now don't want to buy it because they don't believe that an 8% yield is sustainable. But if you look back at the COVID crash a couple of years ago, the yield was 10 or 11%, and there was no fundamental problem with the company at all. But there we go. Either I'm right or I'm wrong. Either way, it looks attractive.
Okay, thanks for sharing that one. And what about a second company you'd like to talk about?
So the second one is Telecom Plus, which is the UK's only, or at least it's a multi-service utility supplier, and it supplies a wider range of services than any other utility supplier in the UK. So it does electricity, gas, telephone, landline, broadband, mobiles, and home insurance. So what makes Telecom Plus interesting is it's completely different to all of the other suppliers. So most utility suppliers, they use what's called a tease and squeeze or price walking approach to pricing. They will offer unsustainably low teaser prices on comparison websites to attract new customers. New customers sign up, and then over time, even mid-contract, which is very annoying, they will ramp the price up by inflation plus 4% typically. So they bring you on board with a low price that is not profitable and is probably making a loss for them. And then over time, they hope to keep you on long enough until they can actually make some money. The problem with that approach is that you're constantly attracting customers who are chasing the lowest price. And so the problem is, as soon as you start to put the price up, those customers, you're attracting switchers, people who are used to using price comparison websites. So they will then, as soon as the price starts to go up, they'll go back to the price comparison website and look to switch again. So Telecom Plus's approach is the complete opposite. They specifically target people who don't want to switch. They're looking for people who are not that bothered about having the absolute cheapest deals in the market. They're looking for people who just want a reasonably decent price, not to be ripped off, and they want simplicity. They would rather have all of their services, all their utility services from one supplier and get one monthly bill and then forget about it because they've got better things to do than go on price comparison websites. That's what Telecom Plus gives them. Their trading name is Utility Warehouse. But what they do is they specifically target, right, so the problem with these people who don't want to switch, the problem is that they're not on price comparison websites. And if you do Wizzy TV adverts, they don't care. They're not interested in any of that. They're not interested. They're disengaged in the jargon. So the problem is, how do you contact these people who are not engaged with switching? So what Telecom Plus does is they have, I think it's about 50,000, what they call partners, who are mostly existing customers. And these are people who earn a bit of money on the side, although some of them run full-time businesses, by promoting Utility Warehouse or Telecom Plus to their friends and their family and their colleagues at work. And if they're more serious, then they might have a website, or they might have a stall in the middle of a shopping centre or something, offering entry into a free prize to win £20,000 or something if you give them your details. Whatever. It's a much more hands-on approach. They go out and they specifically look for people who are disengaged from the normal distribution channels that utility companies use, i.e. the price comparison websites. So it's completely different. And so the idea is that once these people switch, and if they switch all of their services, then Utility Warehouse is able to offer competitive pricing and also make a decent profit, because they aggregate customers across electricity, gas, broadband, mobile, and insurance. And that the fact that they can gather customers across multiple product lines enables them, if they run like a single low cost office, or where most people now, most of their employees work from home, so their customer support costs are very low, and they've optimized the business to be able to run on relatively thin margins that allows them to make a decent profit without having to keep ramping prices up and up and up all the time. So anyway, it's fundamentally a very different business to all of the others. Yeah, and so in terms of the quality and the defensiveness and the value, quality, it's produced double-digit returns on capital employed for a long period of time. It's had mid-single-digit growth for many years. They're a very focused business. They've been around 25 years, basically running exactly the same business model for the last 25 years. Their competitive advantages are that, they're different. They've got this sales force effectively of 50,000 people. None of the other utility companies have got that, and it would take years and years and years to build one up. And the founder is still the executive chairman. That kind of owner-manager approach tends to give companies a more long-term focus, which can be an advantage. In terms of defensiveness, yes, it's a defensive company because it's a utility supplier. It doesn't have to worry about any of the hedging costs of energy and gas because it has a specific deal with E.ON, where it basically buys energy, electricity and gas off of E.ON and then just passes that on to its own customers, with a slight margin. Yeah, and in terms of internal risks or things that might make it fragile, it doesn't have a lot of debt. It just seems like a nice, steady business. There's possibly an issue around the contracts that it has with suppliers, because I think it only has one supplier for each of the utilities that it supplies. So it might take telecom services from EE as a white label service, and relabel that as its own services. However, it doesn't think this is a problem because most of the contracts are very long, and it says lots of the other suppliers kind of fight with each other to sign deals with Utility Warehouse, because Utility Warehouse or Telecom Plus gives these other suppliers access to parts of the market, i.e. these non-switchers, that they can't normally access. So I don't think that's a particular problem. And then, okay, so valuation. The valuation is not as attractive as it used to be. So the yield now is around 3%. My dividend model expects dividend growth of about 7% for the next decade, and then a guesstimate of 4% after that. And so my fair value estimate is £25, and the current price is is £20. So there is a margin of safety. The current price is still below my estimate of fair value, but only by a fairly small amount. That's largely because in October last year, the share price was £10. So my estimate of fair value was 25. The share price was 10. So that looked really attractive. And over the last year, Telecom Plus's share price has gone up by 100%, as all the other energy suppliers, or most of them, have gone bust, and then people have begun to realise that this is a very different business and is run in a much more sustainable way than most of the other energy companies that were attracting customers with unsustainable pricing. Yeah, so the valuation isn't as attractive as it was, but I do think this company has got good prospects ahead of it. I think if it continues to be run well, it's only got about a 2% share, I think, of the total utility market in the UK. So there's an enormous amount of growth potential there. So even though the valuation isn't as attractive as it was, I'm still happy to hold.
Yeah, I can see it's had a fantastic year. Okay, John, thanks for sharing those two companies. If you could go back to when you first started investing, in hindsight, is there anything you would have done differently with the knowledge you have now?
I think kind of everything for that. Well, it's difficult to answer really, because if I went back and I was me now back in 1995, I would invest completely differently. I wouldn't, I started off as a passive investor, but I think the fundamental error that I made was in 2003 when I sold everything because the market had fallen by 50%. Because like most investors, or most novice, inexperienced, naive investors, you think the only thing you know is the price. That's the main thing that you can see. And so when you see the price go down, you think that the value of your investments has gone down. But that's not true at all. It's simply that some other investors have decided to buy or sell the shares or the FTSE All Share at a given price. It doesn't mean that the intrinsic value of the underlying businesses have changed at all. So I think the key thing, if I could go back and teach myself something, it would be that there is a difference between the intrinsic value of a business or even of an index and its price. And if the price falls, that isn't necessarily a bad thing. If the intrinsic value has stayed roughly the same as it probably did, as it did when in the dot-com bust, the intrinsic value of the FTSE All Share probably didn't change materially between 2000 and 2003, but the price halved. So if you think of it in terms of, well, it's like the market's gone on sale. It's like a 50% off sale. But that's obviously a good thing. If you're still in the accumulation phase as an investor, then the fact that the price has halved is good, because it means you can buy twice as many shares that have the same intrinsic underlying value than you could before. I think that would be the key lesson, I think, that I would teach myself.
Okay, that's great. Okay, Jon, thanks so much for coming on to the podcast. Where can listeners go to find out more information about you?
The best place is just to go to my website, where I write a blog and a monthly newsletter. So the website is ukdividendstocks.com. There's also, that site's been up for a couple of years. There's also an old site that I used to write at for about 15 years or whatever it is. That's called ukvalueinvestor.com. So if you want to have a look at an archive of articles covering lots of different companies, have a look there. But the new site is ukdividendstocks.com.
Okay, Jon, thanks so much for coming on. It's been a pleasure to listen to you.
Yeah, it's been fun. Yeah, it's been good.